Good afternoon, everyone. Hope everybody's having a fantastic day. It is 1 p.m. my time. I don't know what time it is in your neck of the woods, but I am pleased to be here again for another webinar with you all. Just to verify that you can hear me, that you can see me, if you do not mind throwing a quick, hello or thumbs up or something in the chat. Okay, yep, okay, sounds like okay, people raising hands. You all just respond so quickly and I love it. It's so wonderful. So I know under my name it says, or under my video it says I'm Heather Bangma. That is my colleague. My name is called Natalie Joy. I am the academic director here at Enriched Academy, and I love doing these webinars. The primary reason why I love doing these webinars is because our goal in Enriched Academy is to make financial literacy accessible to everyone. And that is no matter who you are, how much money you make, how much knowledge you have, we want to reach you where you are. And that is also why partnering with CISIP has been a really fun adventure for us, because CISIP Financial is also there to meet you where you are, and on top of which really understand specific military needs. And I believe we have Margaret here with us from CISIP. Thank you so much, Margaret. How are you?
Not too bad. It's my pleasure to be here. Thank you.
Awesome. Thank you. Okay, so Margaret will be here to keep an eye on the chat, but also we'll be able to answer questions at the end of the presentation. So we have the chat opened up, we have the Q&A opened up, but obviously the chat is probably just your easiest place to go. So if you have any questions while I'm presenting, feel free to throw them in there. I may not see them right away, but if Margaret sees them, maybe she can answer quickly, or we can always take a look at all the questions at the end of the presentation. So today's presentation will be about 35 minutes long with some time for questions afterwards, obviously. Before we really get into it, though, I do want you to take a quick look at the disclaimer we have on the screen. Like I said, Enriched Academy is a financial literacy organization. So our goal is to give you the education and the information you need to then look at your own situation and make the best choices for yourselves. Now, this information has been reviewed, but every financial situation is different. Every person's needs are different, which is why we highly recommend you then take the information you learned today and talk to somebody at CISIP, talk to your accountant, talk to your whole team of financial experts to help you make the best decision that will work for you and your family. Now, with regards to CISIP, in case you are not familiar with what CISIP Financial is, you may have heard of CISIP Financial with regards to insurance, which like they are excellent at, obviously, but that's not all that they do. They are there with financial advisors to help you plan your whole financial future. They're there to help you with debt reduction. They're help you there to better understand your pension. Essentially, pretty much anything you can imagine from a financial standpoint, there's somebody at CISIP that will either be able to help you or guide you to the right services that will. And there's a huge network of CISIP like representatives across the country. So chances are there'll be one near in a base or near a base near you. Or if that's not the case, you can also go online, phone, email, virtual. There's all kinds of options. I just want to make sure that you know that you have access to this, because CISIP really truly understands your military needs and will be able to tailor whatever your goals are and like tailor whatever programs you get into based on the goals that you have. So today we're talking about the ever so exciting taxes and registered accounts. Now I'm being slightly sarcastic here. The thing is, I actually really like talking about TFSAs and RRSPs because I actually feel like the registered accounts are somewhat of a misunderstood tool. And I want to make sure that you have a better sense of what actually these tools are and how you can use them. So we're going to start off by talking briefly about taxes and why we pay them. Like, where does this money go? Then we're also going to discuss tax deductions and credits that might be available to you. We'll talk about the differences and similarities between RRSPs and TFSAs, and then also talk about like some other tax shelters that are available that you're potentially not aware of. Now, to start off with, I don't think I'm telling you anything new or surprising when I say that we live in a pretty exceptional country. Canada is pretty wonderful, and we're very fortunate that we live in this country. But Because we live in this country, our governments have made sure that we have access to a plethora of services that allow us to feel like we are having the quality of life that we do. So, why do we pay taxes? Our provincial taxes, territorial taxes, federal taxes, they go to things like healthcare, to teachers, to road repair, to parks, to police, and even also to fund the military. Um, and like all of these things are beautiful, essential, wonderful things that really help make our country as wonderful as it is. Now, the federal government manages about $250 billion of revenue in different ways here. So we're at approximately 47% comes from income tax, about 24% comes from sales tax, 16% from social security, 11 from property tax, and 2% from others. So like there's a lot of money that is generated to take care of all of these services. Now, you contribute to the federal taxes on your income taxes every year, as well as the provincial and territorial. So you have to pay both sets of taxes every year. The way this works is it's based on taxable income. Now, you've probably heard the term tax bracket. So, essentially, what that means is based on the amount of income you have, you fit into a certain category. And based on that bracket, you pay a certain amount of tax. So, generally speaking, well, this is what you can see here based on the table for 2024, right? If you're making up to $55,867, you'll be taxed at 15%. There's exceptions for this under $10,000, but I'll actually get to that in a second. But as you can see, the more income you make, the higher your tax rate. So in theory, this is also to ensure that the people who make less money are paying less in taxes, and the people who make more money are paying more in taxes. This is also that concept too of the fact that like no matter how much money you make, ideally you're investing that money by spending it within your country, which is contributing positively to the economy as well. For your provincial or territorial numbers, they vary greatly by province and territory. So, what I highly recommend is you go to canada.ca and take a look at the provincial and territorial income tax brackets, right? Look for your specific province or territory so that you can know exactly where you fit into all this. And there's a reason why knowing what tax bracket you're in will be very useful to you when we get to registered accounts. Just to give you an example, though, let's say you make $10,000. Okay, so maybe you aren't making $10,000, but let's say your teenager has their first part-time job and they're making around $10,000. Well, $10,000 and under, there are no federal and provincial taxes taken off. So that's great. We do, however, always contribute to CPP, the Canadian Pension Plan, and employment insurance, EI. The rate for CPP is 5.95% at this point and 1.66 for EI in 2024. Every year, those numbers will change a bit, so it's always a good idea to keep an eye on that, again, through the CRA website or, through other means. So on $10,000, you are only having deductions for CPP and EI. So you're only paying around $553 in deductions. So it's about 5.5%. So this example is in Ontario. Of course, in the next slide, those numbers will vary based on which province you're in. So let's say you're paying, or you're making, $1 million. Well, you're going to pay about $304,000 of federal tax, about $189,000 of provincial tax, the same CPP 5.95, EI 1.66. Now, just so you know, also CPP and EI, there is a maximum of which you have to pay, just so you know. Those vary. So you'll want to double check that too, but this is based on your income. So your deductions are around $498,000, which means you net pay is about $502,000. So if you make $1 million, you're paying approximately 50% of that in taxes, or in taxes and deductions, I should say. Now, to put it into context, the average Canadian family paid around 45.3% of deductions in 2022. So the average family income in Canada in 2022 was around $106,000, and they paid around $48,000 in taxes and deductions. Now, it does seem like a lot, but like I said, there is a cost for being able to live in a country that has the services that we have. I'm just going to double check to see if there are any questions popping up right now. No, it seems we're good. Don't hesitate. Throw them into the chat box at any time. I may not always see them right away, but I will get to them. Okay.
I actually see one hand up. There is Simone or
Yeah,
Simon.
so we unfortunately don't have the
It's gone
microphones
now.
aren't available. Oh, okay, it's gone now. But if you do have any questions, don't hesitate to put them in the chat. Your your microphones aren't available right now, unfortunately. Okay, tax deductions and credits. There is actually a plethora of them. They're like, it's a good word. I like that word. Plethora. There are many. There are a lot. And not everybody's aware of everything you have access to. So this is just a sampling of what you could have access to. Now, I want to clarify as well that as members of the military, you may also have benefits, credits, deductions that are already embedded within within your salaries, within your positions, right? So this is where talking to CISIP first before you kind of really dive into this could be useful, because you may not need some of these based on, let's say a relocation credit and things like that that you may get through your relocation. So always check with a financial advisor or I was going to say a lawyer, not necessarily a lawyer, an accountant. That's the term I was looking for, to make sure that it applies to you. But generally speaking, these things, you just keep your receipts. Keep your receipts. That is the key thing. You always want to make sure that you have proof of these things, right? So, employment expenses may not apply to you, but let's say you do have a spouse who runs a home based business. Well, they may be able to claim those employment expenses because of their home based business, right? So, that's something you can take a look at. Tuition fees and education expenses, very useful to take a look at, especially if you have children who are in university or college. Interest on student loans, certain medical expenses are covered. Childcare costs. If you have a child in like a registered daycare, they should be giving you a receipt at the end of each year so that you can claim that on your taxes. Moving expenses, which I'll get into in a second, and then all kinds of other things. First time home buyers plan, I'll get to that in a second. Awesome. Tax credit for charitable donations. So that's something we do see pretty traditionally, right? That's something we automatically assume, especially most places. If you make a donation over $20, you'll automatically get a credit, or not a credit, but like a receipt to then put onto your taxes. Amazing. But there are all kinds of other credits that could be available to you. So it takes a little bit of research, takes a little bit of time, but I highly recommend you check them out. So, one example is of these moving expenses. Now, we do know that like a lot of military members move frequently, like sometimes once a year. And within your sort of organization, you have services available to support you through these relocation pieces. Okay. So we highly recommend that you check those out, because certain things may already be covered for you. You may already be able to receive certain credits. But over and above that, you may be able to apply some of those expenses that weren't covered in that area through these moving expenses credit. So this is just an example though of an average Canadian. Let's say they spent $1,500 for a moving company and $500 on travel expenses, and it costs them about $8,000 in fees to sell their home. The tax deduction 10,000, tax rate 20%, they could be saving around $2,000 on their taxes that year. Is that, a make or break situation? No, but it adds up. It can make a real difference if you really try to maximize all those credits that you may have access to. This other one, the HBP, this is a bit of a tongue twister, is awesome. And not a lot of people know about it, so we want to make sure you know about it. If you are trying to save up for a down payment for your first home, and you already have, let's say, an RRSP that is, well funded, you can borrow up to $35,000 from your RRSP tax free to purchase your home. And we do say borrow because essentially what you're doing is you are borrowing from that account to put a down payment on a home. And then the year after, so the second year after the year you purchase the home, is when you start making regular payments for the next 15 years. So you're borrowing on your own account essentially, but you have to pay that back. but that money that you borrow is tax-free. You're not having to pay taxes on what you're withdrawing. And you can combine this with your partner's one for a maximum of $70,000. So for those of you who are looking to buy their first home and are not sure that they can really save up enough for a down payment, you want to look into this. This could be a really valuable tool to allow you to enter into the housing market. So really great. There's a ton of information about it online. SysIP can also help you kind of look at the calculations to see if it makes sense for you. And another tool for saving on your taxes overall are TFSAs and RRSPs, also known as the two primary registered accounts that we have here in Canada. There are other registered accounts, which I'll tell you about in a second, but if you invest using these resources, you can actually have a relatively good amount of savings with regards to your taxes. And I will explain why in a second. So let's take a little bit of a deeper dive into this concept of registered and non-registered accounts. So like, what is really the difference between the two? The base answer is that the registered ones are registered with the CRA and the non-registered ones are not. Pretty simple, pretty straightforward. That's the basic answer, but it's a little bit more complicated than that in the sense that our government's created registered accounts essentially as a way for Canadians to be motivated to save, especially like the RRSP to save for retirement, and the TFSA to actually be able to save more for short-term and long-term goals, right? But still allowing money to be invested back into the economy, which I'll explain in a second. Registered accounts offer tax incentives, right? So they're like a double bonus, right? Because you're not just saving for something that'll be important to you, but you're also receiving some sort of tax benefit, which is great, right? Your savings, they grow tax-free, which is incredible. And I'll explain kind of what that means in a second. And really, there are all kinds of different accounts that for different life stages and different goals. Non-registered accounts, honestly, the biggest pro with those is that they're more liquid, right? You can withdraw money anytime, you can add money anytime, but you're also being taxed on all that you're gaining, right? So it can be tricky. Like when I say the term tax shield, that's what you may have heard about that. And that's the idea, right? That registered accounts or non-registered accounts, I should say, don't shield you from taxes. Anytime, anything you make, anything you withdraw, depending on the type of account, you're having to pay taxes on it. Whereas registered accounts are shielding you to a certain degree. Two registered accounts I'm going to talk about just very briefly that you may not really have at the top of mind, but that can be useful and applicable to you are RESPs, which are the Registered Education Savings Plan, and the RDSP, which are the Registered Disability Savings Plan. So RESP is the sort of account whereby you can save money up for your children, your niece, your nephew, your like somebody within your family, grandkids, etc. And everything you invest into there, the government will then match up to I think up to 20% and up to a maximum of just slightly over 7,000. I can't remember the exact amount, but like a substantial amount, right? And the thing about this is 20%, that's I don't know if you're familiar. That's a lot in the case of like being able to have an investment income. That's a lot of money that is coming in, right? And that's great. That is an exceptional return. So if you can utilize that as an option, I highly recommend you do. And the RDSP, the Registered Disability Savings Plan, has a similar sort of program where the government will match up to a certain amount. So if you do have a family member that you know may require more support later on in life, and you may want to make sure that you're setting them up for success that way, the RDSP can be an awesome tool. So I definitely look into that if it's something that you think could fit you and your family. Okay, enough about those two little ones. Let me just give you kind of a glimpse of the difference, just on a basic level, between registered and non-registered when it comes to how much money you have in your pocket at the end, right? So let's say you were investing $500 a month over 30 years at an 8% return. I will pause and preface that an 8% return is high, and 500 a month may be high for the average person, but this is just an example, okay? If you had a registered account At the end of the 30 years, you would have about $755,000. If you had a non-registered account, based on the capital gains tax you would have to pay, you'd be looking at around 651, pardon me. And this is a big reduction of money that you want to keep in your pocket. So we always recommend, with regards to like a savings vehicle, that you're maxing your registered accounts before you are investing using non-registered accounts, because you will have more tax benefits that way. I'm just going to take a quick look at the chat again to make sure everything is going okay. What if you wanted to use the money to own a business or buy a business? That is actually a good question. Um, we will have Margaret and myself address that when we get to the end, unless Margaret wants to throw in an answer in the chat right now. But we will come back to that question for sure. I think it's an excellent question. Okay, so TFSAs, RRSPs, what are the similarities? What are the differences? First similarity, RRSPs and TFSAs are not investments. Repeat after me, write it multiple times in your head or on paper. They're not investments. The reason why I'm like harping on this is because we've actually seen a lot of our clients come to us and go, well, I've put X amount of dollars in my RRSP and it's been 5 years and it hasn't grown at all. Like it's hardly done anything. And we're like, okay, well, like what did you invest in with the RRSP? And they're like, well, I didn't, what do you mean? Like I invested in an RRSP. This is a common like misconception here. The RRSPs and the TFSAs are not the investments. They are accounts that you will use to invest in the investment vehicles of your choice, right? Stock, bonds, GICs, etc. It's the account that you're going to use to invest in something, right? So those registered accounts, they're only as good as the investments inside of them. And if you're concerned, like, I don't know how to invest, I don't know where to start, this is where, join some of our future webinars. We'll help give you some tips on that. But also CISIP Financial is the best place to go with regards to giving you the options you may have about what to invest, where to invest using that, right? Another similarity is that all registered accounts grow tax-free until they're withdrawn. Okay. And I'll kind of explain what that means in a little bit. And you also have the freedom to choose where you're investing that money. So that part is awesome. Now, with regards to like that tax piece, right? Paying tax before withdrawals, you kind of want to think of a TFSA and an RSP almost being mirror images of each other when you think about it. So let me try to explain a little bit more. So the idea is that for the RRSP, the government is expecting that you're going to invest in this for the long term, right? You're not going to want to take money out of that right away. You're going to invest in it in the long term. And when you take the money out, when you start withdrawing the money, you, in theory, because you'll be near retirement or retired, you'll be making less money. So your tax bracket will be quite low, which means that whatever taxes you're paying on that withdrawal will be lower, ideally at a lower rate, right? If you start taking money out of your RRSP willy-nilly whenever you feel like it, if you're at a high tax bracket, then you're going to be paying a significant amount. You're going to get dinged a lot on that withdrawal. You're not going to be able to maximize it, right? So, and the idea too is the RRSPs, like the benefits are happening for you at the beginning and then ideally near the end, right? So when you are contributing, let's say like $20,000 into an RRSP, the government sees that as you having $20,000 less income. So if you were at a specific bracket, when you contribute to RRSPs, it may actually reduce your income to a lower tax bracket, which means that that year you'll actually be paying less income tax. So it's a great vehicle to help you if you're in a higher tax bracket and you want to pay less income tax that year. And also, it's a great vehicle for the long term, because if you want to make sure you're only taking the money out later, you'll be at a lower tax bracket, chances are, by that point, and you won't be paying as much. The TFSA is like, it's like the opposite, essentially, right? It's that idea that like you will have already paid taxes on it before contributing to it, right? Because like, so you're paying income tax and whatnot as you're being paid, right? So when you take the money out, you are not paying extra tax on that. So it's excellent. Particularly excellent too, because if you are wanting to take the money out sooner than you would with like a registered retirement account, it can be very beneficial. So, RRSPs, pros and cons. What are we looking at here? Essentially, like I said, that immediate tax deduction, you may get moved to a lower tax bracket, which means you are paying less income tax in the moment. Any contribution you don't make that year can get carried over, and that can, balloon a little bit. So that can be helpful if down the road you want to add more into your RRSP. It's essentially a self-funded retirement plan, hence why the government created it to help Canadians self-fund their retirement. Now, you have access to a pension, but I do also want to confirm that the majority of Canadians need 3 to 5 different income vehicles to retire in essentially a free, comfortable way. So you'll want to look into your retirement, how much your pension is, and how much you could get from your RRSP among other incomes, the old age pension, security, etc., to see if that's going to be what you need to retire in the way that you want to. We have a calculator for this online, which I'll talk about in a second. And then, yes, by the time you do withdraw the RRSP, chances are you're in a lower bracket, which means you'll be paying less tax on it. Now, the cons is, you're paying tax on the withdrawals, right? So that's why you have to be very precise about when you're withdrawing. You have to withdraw at age 71, and there are limits, right? You can't just contribute anything that you want. Though, like I said, the contribution room does carry over. So here's an example. If you make $100,000 and have $10,000 to contribute to an RRSP, based on our calculator here, if you're living in Ontario, you'd be saving around $3,000-ish on taxes. Not bad, not bad at all. So you've contributed to your retirement, contributed to your savings, and you get a tax benefit. It's great. This particular it is cool. Our tool that is cool is our RRSP calculator. It is in the Enriched Academy portal. It is a tool you have access to as part of our partnership with CISA. So our portal has videos that are, educational and self-guided learning, but also a ton of downloadable tools, the CISA budget tool, all kinds of Excel, Google Sheets, PDFs. So you don't have to reinvent the wheel. You don't have to do all this math yourself. We have tools that are already created for you. So this one is great because you download the RRSP Excel tool, you select your province, you fill in your income tax and savings information, and it'll explain to you, essentially based on provincial and federal brackets, how this is affecting you and how much you could save on your income taxes. So it's a very, very useful tool. We also have a retirement, also called financial freedom calculator. So if you want to get a sense of how much you may want to contribute to an RRSP and other savings tools, your pension, etc., to see if you can really retire in the ways you would like to, there's that tool as well. Tax-free savings account, the TFSA. Pros and cons. Now, the withdrawals are tax-free, which is great. Perfect for short and long-term goals. So think emergency fund, think vacation 2 years from now, think essentially whatever you can think of as far as a short-term goal. TFSAs can be great because you're not taxed when you withdraw the money. So you can withdraw essentially whenever you want without that penalty. And it can be an excellent support tool to the RRSP if you are maximizing that one and want to make sure that you still have another registered account that will give you some tax freedoms as well. The contribution room, just like the RRSP, does carry over. That said, the limit annually is only $7,000. So it's not a huge amount that you can contribute each year. It's particularly a great tool for growth investments. Now, what I mean by that is if you're investing in something that you think will have a very high return very quickly, but that it's volatile and you may want to sell and get that cash in your pocket immediately, TFSAs are a better tool for that than RRSPs. Because like I said, you're not paying taxes on what you withdraw. So if you have a short, spike up and it's great, wonderful. TFSA is probably your best tool for that, so you can access that quickly. RRSPs, you want to leave that money in there for as long as possible because you have to pay when you withdraw. So using the RRSP for more volatile investments can be tricky. Again, every situation is unique though, so you'll definitely want to check with your financial advisor to see what works best for you. So for example, if you're making $100,000 and you're investing $20,000 in a TFSA, that $20,000 initial investment, after all that time, you're making $200,000, right? It's all yours, no capital gains paid. If you have a non-registered account or other types of investments accounts, you might have capital gains that you have to pay, in this case, around $41,000. So it really depends on what type of goals you have and when you want to have access to the money, right? So why a TFSA? TFSA is really awesome if you have all kinds of different savings goals, right? Like I even know some people who have, 2 or 3 TFSAs because they like to have one for their vacation, they have one for the emergency fund, and they have one for something else, right? Now, always verify with your financial advisor based on maximum amounts though too, because you can have multiple TFSAs, but the contribution room is still, maxed out at 7,000. The growth investment piece, right? If you know that you're dealing with a volatile market and you might want to have access to something quickly, TFSAs are useful for that. RRSPs, if you have a high tax bracket and you want to get immediate results with lowering your taxes, RRSP contributions are a great tool for that. Like I said, double bonus, you're saving for your retirement and you pay less taxes on an annual basis. And that way, RRSPs are also great as a tool to kind of force you to invest for the long term, right? Because if you withdraw, you may have to pay. Well, you will have to pay on that. It forces you to plan regular monthly payments, working at the long term, and knowing that you are sort of doing a regular contribution to something that will have a serious impact for you down the line. And so it can be something that makes you feel more secure as well as you're moving forward towards retirement. So what are your action steps? After this webinar, what do I want to see you do? Okay, so there are a few things. One, I want you to take a look at what your tax bracket is, right? And what tax deductions you might be eligible for that you didn't know you might be eligible for, right? So really take a look at that. You can get that information on the CRA website. You can get it on, like I said, the canada.ca website. And some of that stuff may also be available in your notice of assessment. You want to also check in with an accountant if you can, because they may help you see credits and deductions that you didn't know you were eligible for. And some of them you can apply for them, after the fact. Taxes are complicated. I'm not an accountant. You want to talk to an accountant to make sure you are applying for the deductions that make the best sense for you. Next, you're going to check with the CRA to determine how much RRSP and TFSA contribution room you have, so that then you can decide which ones make the most sense to invest in based on how much you have to invest. You're going to either open that account, the TFSA or the RRSP. Sometimes both can be useful. And then you're going to also want to research what you want to invest in and start making those regular monthly investments. Because like I said, a TFSA and an RRSP isn't an investment. You have to use that account to invest in something so that you can generate the returns. And that will really vary greatly based on your risk assessment, your values, your goals. And that's why you're definitely going to want to work with a financial advisor to get your best plan put in place to really support you with that. So that is the basis. That is like the meat and potatoes of this TFSA RRSP presentation. The last two things I want to give you as pieces of information before we really get into the questions is these 2 QR codes. I've also put the links in the chat if you need to copy the links. The left-hand side is how to register for the Enriched Academy portal. If you're not in our portal already, there's no cost to you. It's part of our partnership with CISIP. You register within 1 to 2 business days, you'll get an email with your login information. You have access to the online courses and all the downloadable tools, including the CISIP budget tool, which is really specific and targeted to your unique income and your unique needs. So definitely check that out. And on the right is how you can specifically contact CISIP to schedule an appointment with one of their advisors. Again, highly recommend this. I think it's just so amazing that you all have access to an organization that really understands your fluctuating needs and all these elements that are different about your lives. And you already, quite frankly, you already contribute so much to our country, and your stress level is potentially quite high and higher compared to the average Canadian. Like, I think it's fantastic that you have access to financial supports that will allow you to bring that stress level down so that you can, contribute positively to your work, to your families, to your own lives, to your communities. Needless to say, we are very proud to be able to partner with CISIP and the Canadian Armed Forces. We think it's pretty special. We're very lucky. Okay, so let me just take a look at the chat here. Okay, so we see, I'm just seeing if Margaret has answered any of these questions. It doesn't seem like, I can't see the link for the codes on the screen. So if you go into the chat function, I have the links posted there. So if you're not able to get the codes themselves, the links for everything is in there as well. All right, let's see here. Margaret, how about we take a look at that first question?
Yeah, that's no problem.
Yeah, what if you wanted to use the money to own a business or buy a business? That's a really interesting question.
Well, maybe I jump here if you don't mind, Natalie. Joy, it's your own discretion. It's depending where you're contributing the money, which account do you have, if it's registered or not registered. The one advice will be here, just use the money, which is no tax consequences. So probably I would advise first withdraw from the account which allows you to do that, which is tax-free saving account. And after that, whatever account you have, it's also depending what is your cash flow. First, we will have to discuss what account you own and what you have, because as I said, and also the same thing said Natalie, Joy, if you own the account, which is register account, and you start withdrawing from RRSPs, that's towards your retirement. I would not recommend to withdraw towards your business. However, it's everyone's discretion.
Yeah, makes great sense. Next question. Can I transfer my current RRSPs to my spouse that doesn't have a pension?
Would you like to go ahead, or would you like me to
No, you go. You go right ahead.
Okay. So RRSP is based on the contribution room. If you yourself, you have a contribution room to contribute to your spouse RRSP, that's perfect. That doesn't implicate your spouse contribution room. So you can go ahead. If you have availability in your contribution room, you can split the contribution between yourself RRSP and spousal RRSP.
Yeah. And the thing too about individual taxes and contributions and things, and then also family couple taxes and things, it's obviously couples twice as complex, right? So you'll also want to make sure to really take a look at, don't just make assumptions based on what you know as far as what's okay as an individual. You'll also want to make sure that you understand how it works whenever you are with a partner. Can you confirm that these tools through CISIP are available to civilians as well? That is an interesting question. So my understanding is that to register for our portal, you do need a CF1 number. So if you don't have a CF1 number, you can obtain one. If you have any other questions with regards to that you may want to email me directly. My email is in the chat. I'll add it again at the bottom before we head out, because I can confirm specifically what's going on with how you have access to the portal. The other question I see here, Margaret, can you potentially lose money on an RRSP? I mean, you could lose money on a TFSA as well, technically, right?
So as we saw it here on the presentation, each register account can be potentially invested. The money put it there can be potentially invested. So the investment, the way it's invested is depending how it's invested. It's depending on the discovery meeting with your advisor, how they assess you by your risk tolerance, your time horizon, your net worth, and so on. All of these factors is based on the risk. So it's depending how it's invested. So simply, if you are potentially high risk or low risk, that will show us how we can, which funds we can choose, how we can invest. If those funds are medium risk or low risk, yes, there is potential that the investment can go down because the market right now up and down fluctuation. You have to keep that in mind. If you have a longer period of time when you're investing, you have less possibility of losing, because we take in an average around 10 years average of your investment, and that's give us the average of your return. If you starting investing to your RRSP, start the opening account RRSP, and the money is invested when you're young, you potentially have potentially higher chance to actually earn money and not to lose, because the market, as I said, go up and down as a circle, so go up and down, and in that period of 10 years, maybe the market is up and we take in that average. So yes, there's always potential, but everything is depending on the discovery meeting with your advisor. So advisor job is to assess your situation and make sure that you're not gonna lose the money. Make sure that you don't have, if you don't have capacity to lose that money. This is all based on the discovery meeting with your advisor and how advisor educates you.
Yeah, and what I find, I mean, before I started really having a better grasp of all this, the idea of the market fluctuating scared me so much, and I can understand, because especially if we're looking at it every day, it's like we it's just like it's scary because it's not stable. But if you actually take a look at what the stock market has done since its inception, there have been more positive years than there have been years where there have been crashes. And the overall, I believe the overall percentage of return is like 7 or 8% over the history of the stock market. So like that's why we always recommend that if you can invest, that you are doing so over a longer period of time, because then it weathers those ups and downs, right? But you have to accept right away the ups and downs are part of it. And you're right that, Margaret, you're totally correct. When you're speaking to somebody who has a better understanding what types of investments you can get into and work with, some are historically more risky than others. So when they have a better sense of what your risk tolerance is, how long you have to invest, all these sort of markers, they can advise you as to what will ideally grow the most securely for you. But investments are risk. It is what it is, but they're an excellent tool for being able to save if you are using the correct one in the correct time. Da, 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 do, 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 do. Okay, just looking through. Oh, hi, Carolyn. Carolyn's here with us. Delightful. So yes, okay, so yes, family members are also available to be able to access the SISIP tools. Awesome. The SISIP EA partnership tools. The toolkit we have ready for you. So that is delightful. Let's see, do we have any other questions that we haven't currently answered? I want to make sure that we've covered it all. Once you retire, you split the pension. Okay, so yes, there's a response to Simon's question about splitting, transferring to the spouse in the chat as well, so that could be useful for you. And notwithstanding the limits you're allowed to contribute to your TFSA, can I use my TFSA to buy and sell securities and essentially use it as a bank account? That's an excellent question. Margaret?
Well, withdraw from any tax-free saving account is your money, your funds. It's your decision what you're going to do, where you're going to use that money. You keep in mind withdrawing from from tax-free saving account is free from taxes. So wherever you put that money is up to you guys. You the people who own the money. And the second portion of that question, Natalie Joy, what was it?
Can I essentially use it as a bank account?
The tax-free saving account is not a bank account. It's not a checking account. Checking account for in and outs when you're doing your expenses, paying the bills or so, that's account open with the bank itself. Tax-free saving account is a registered account. The idea of that account is not to use as a checking account, not in and outs. You can start save the money, you can invest the money, but those accounts are registered. The idea of it is not to use on like daily basis for in and outs. The idea of it is to keep the money there and let the money grow.
The nice part about TFSAs, though, is because of you're not taxed on withdrawals, it can be useful for the short-term goals, right? So yes, it's not to be used every day for paying the odd bill, but it is great for that fact that, like, yes, you don't have to sort of jump through hoops to be able to withdraw the money when you want it. Let me see here. Okay, so Carolyn's saying CF1 numbers aren't required. Yes, that is correct. I'm just confirming that on the registration page for the portal, it will ask you for a CF1 number, but it is not a mandatory field. So if you have a CF1 number, we would love to know it so that we can make sure that you are registered in the right place. But otherwise, as long as you're making sure that all the required fields are filled out, you'll be able to have access, you and your family. All right. Let me see. Do we have any other questions?
You confirm those
okay. If I have $100,000 in my TFSA and I buy Bitcoin and next year it's worth $1 million, will I have to pay capital gains on the 900,000K profit? My understanding is no.
If you don't mind, I'm just gonna add here. If you're doing this on independent platform, I'm just not gonna say anything. With SISIP, we invest with mutual funds, so we do not invest in Bitcoin. So those are different rules. So everyone's situation is individual. A lot of our clients invest independent platforms. They asking for advice and so on. We kind of limited what we can advise you on. We in SISIP we invest here on mutual funds.
No, so yeah, there are other things that you can do independently, but I mean, especially when we're talking about Bitcoin, cryptocurrency, things like that, it is such a relatively new method of investment and quite volatile. So, like, yes, in theory, whatever gains you make in a TFSA, you can withdraw without paying tax, but each platform, if you're going outside of a SISIP, organized method that doing this, will have other fees, other rules, other things that you'll want to research more in depth.
Correct. Yeah, that's great answer.
Does SISIP have an RRSP specialist? That's a great question.
So actually, every advisor is correctly trained to provide their services, full services, and also education in regards to any type of account. Like myself, just the other day, I opened RRSP. It's depending on the needs, it's depending what's the client coming, and when we do discovery meeting, what they need. Of course, every single advisor is educated in regards of RRSP or any other account. So don't be afraid. Just come to the office and ask for education, or just even open the account. Don't be afraid. Yes, we are educated on that.
They're not scary, I promise you. They're not scary at all. And I mean, I think so much of why I'm excited that we're partnering with SISIP and to be able to support the armed forces is that we do want to, like, kind of demystify and de-taboo the idea of, like, talking about your finances, getting the support you need. So many Canadians are struggling, and we don't need to be, right? Like, there are resources out there, and it doesn't have to be complicated. It doesn't have to be hard. And we really highly encourage you to, like, just the fact that you're here, that you registered for this webinar to get this information, like, that's amazing. I'm just like, this is awesome that we are able to support you in this. And we really want to encourage you to reach out and form your, like, financial support team to make sure you're getting everything that you need to meet your goals.
I just want to add, if you don't mind, Natalie, Joy, that All of our advisors in every department, every CISIP branch are not commission-based. So if you are looking for the education, that's all you're looking for, we'd be happy to provide that. We're not going to push you to start opening the accounts or so on, so on. We are happy just provide the education if that's all what you need. And we always say that on every single briefing, we also providing each year, or usually most of the briefings are November, December. So just please keep that in mind that our door is open for that.
Wonderful. And it's another part of the reason why we wanted to partner with CISIP is that level of unbiased support that is, it's there for your needs and for your goals, which I think is great. Let's see here. Do we have anything else? Permanent TFSA are the same as those permanent residents. Yes. So I'm seeing Simon mentioning that, yes, there are certain, there's what you can invest in with a TFSA and with an RRSP, very similar, right? But there's many layers to fees and then the taxes and et cetera, based on if you are using a financial advisor versus using an independent platform versus using a different type of, financial coach. There's some variety. So part of what we're encouraging you to do is seek out that education and ask for what exactly all this is going to cost to you, right? So not just in taxes, but in fees and such, so that you really have an understanding of how this is going to impact you and your finances. Let's see. Thank you so much, Joanne. That's very kind of you. I'm glad you were enjoying the presentation. Phenomenal. That made my day. Thank you. I'm going to be writing on that for the entire day. I really appreciate that.
I just want to say fantastic presentation. Lots of details, and it's clear and easy language to understand for every single member. If I can add at the very end here that CISIP Financial look on every single member, whole situation. We're looking into holistic situations, so every single aspect of your life. What do you need? We don't provide only the financial services. We also provide the financial counseling services and insurance. Financial counselor provide the services for currently serving members, not veterans. Keep that in mind. However, it's fantastic help for people who may be looking to set up the budget, looking on cash in and out, and maybe after that you can see how much money is spare in your cash flow. Maybe then it's time to start investing. So those are the services we are offering. So keep in mind our door is always open.
I love that. And you are there to meet people where they are in their journey. And I mean, if you're a new recruit or you're nearing retirement, you're going to have different needs. So I think it's just great. It's just great that you guys are able to support people exactly in their, what we say, the age and stage in our education terminology, which is great. All right. I'm going to add my email again in the chat just to make sure that you have access. That's not how I spell my name. It'd be really good if I knew how to spell my own name. Natalie Joy Cannell. Is that correct? Yes, it is. Enriched Academy. So if you have any further questions about the presentation specifically, and I misspelled it. Let me update that for you. So yes, enrichedacademy.com. There you go. So that is my email. Don't hesitate to reach out. Next presentation we have, so double check on the CISIP webinar website. We are talking about mortgages and home buying. And I believe I'm doing the Francophone presentation, and the Anglophone presentation is being done by Jay Seabrook, who is one of the co-founders of Enriched Academy. He is so knowledgeable related to home buying. He has real estate, investment properties. Anyway, it's like one of his passions. So I think you're going to really have fun with it. So don't hesitate to register. And even if you can't make it, just register. You'll get access to the recording later. Thank you so much to everybody for joining us today. I really appreciate it. I will leave these QR codes up for a few more seconds if you need to scan them, but otherwise, we will see you very shortly. Have a great day, everyone.
Thank you, everyone. Take care.